We all know elections are a big deal. They are the cornerstone of our democracy, a time when citizens come together to make their voices heard and choose their leaders. They decide who leads our country, from the president to local officials. These leaders shape policies that impact every aspect of our lives. But did you know they can also impact your money? Yes, the outcome of an election can have significant financial implications for you and your family. It's true. The president and Congress make decisions that affect our economy. These decisions can influence everything from job growth to inflation rates. These decisions influence things like taxes, interest rates, and even how much your groceries cost. For instance, changes in tax policy can affect your take-home pay and your ability to save. Understanding these financial implications is crucial. It allows you to plan better and make informed decisions about your finances. It helps you make smart choices with your money. Whether it's deciding how much to save, where to invest, or how to budget, being informed is key. Whether you're saving for retirement, trying to build a nest egg for the future, or planning for your children's education, investing in the stock market, looking to grow your wealth through various investment opportunities, or just trying to make ends meet, managing your day-to-day expenses and ensuring you can cover your bills, paying attention to politics matters. The policies and decisions made by elected officials can have a direct impact on your financial well-being. Don't worry, you don't need to be an economist to understand the basics. With a little effort, you can grasp the fundamental concepts that affect your finances. We'll break down the complex stuff into simple terms. From understanding how interest rates work to knowing the impact of fiscal policies, we'll make it easy for you. You'll learn how to navigate the financial waters no matter who's in the White House. Remember, knowledge is power. The more informed you are, the better decisions you can make. The more you know about how politics affects your finances, the better equipped you'll be to protect and grow your wealth. So, stay informed, stay engaged, and take control of your financial future. Many people believe that the stock market performs better under Republican presidents than Democratic ones. Is this true? Well, it's complicated. Looking back at historical data, we do see some patterns. The stock market has generally performed well under both parties over the long term. However, there have been periods of both growth and decline under every administration. It's important to remember that many factors influence the stock market. The president is just one piece of the puzzle. Global events, economic conditions, and even investor sentiment can all play a role. Trying to time the market based solely on political affiliation is risky. Instead of focusing on which party is in power, it's wiser to focus on long-term investment strategies. Diversification and a well-balanced portfolio are key to weathering any political storm. While the president gets a lot of attention, it's important to remember that Congress plays a crucial role in our government. The president may be the face of the nation, but Congress is the backbone that supports and shapes the policies that affect our daily lives. Congress plays a huge role in shaping our economy. They are the ones who draft, debate, and pass the laws that govern our financial system. From setting tax rates to determining how federal funds are allocated, Congress has a hand in nearly every aspect of our economic life. The House of Representatives and the Senate are responsible for writing and passing laws that directly impact your money. Whether it's legislation on healthcare, education, or infrastructure, the decisions made in these chambers have far-reaching consequences for all Americans. Think of it this way: the president proposes an idea, but Congress ultimately decides whether it becomes law. This dynamic ensures that no single branch of government can dominate the legislative process, fostering a system of collaboration and compromise. They control the purse strings and have the power to approve or reject the president's budget. This means that every dollar spent by the federal government must be authorized by Congress, giving them significant influence over national priorities and policies. This system of checks and balances is crucial. It ensures that power is distributed among different branches of government, preventing any one entity from becoming too powerful. This balance is essential for maintaining a healthy democracy. It prevents any one person or party from having too much control over our economy. By requiring cooperation and negotiation, the system encourages diverse viewpoints and solutions that better reflect the needs and desires of the American people. Understanding how Congress operates is essential for investors. The decisions made in Congress can have immediate and long-term effects on the stock market, interest rates, and overall economic stability. Being informed about legislative activities can help investors make better financial decisions. Pay attention to key committees that deal with financial matters, like the House Ways and Means Committee and the Senate Finance Committee. These committees are where much of the detailed work on economic policy is done, and their decisions can have a significant impact on the economy. These committees have a significant influence on tax policy, trade agreements, and other economic legislation. By following their activities, you can gain insights into the future direction of economic policy and how it might affect your financial well-being. Section 4. Election years and your investments. Election years can be a particularly stressful time for investors. The political climate is charged, and the stakes feel incredibly high. Many investors find themselves glued to the news, trying to predict how the outcome will affect their portfolios. Election years can be nerve-wracking for investors. The uncertainty surrounding the outcome often leads to heightened anxiety and stress. Investors may feel compelled to make hasty decisions based on the latest poll numbers or breaking news stories. This heightened state of alert can make it difficult to stick to a long-term investment strategy. The uncertainty of the outcome often leads to market volatility. Stock prices can swing wildly in the days and weeks leading up to an election, as investors react to every new piece of information. This volatility can be unsettling, but it's important to remember that it's a normal part of the market cycle. Historically, markets have experienced similar fluctuations during election years, only to stabilize once the results are known. But here's the thing. History shows us that it's usually best to stay the course. Over the long term, the stock market has shown resilience, regardless of which party wins the election. While there may be short-term volatility, the market tends to recover and continue its upward trajectory. This historical perspective can provide some reassurance during uncertain times. Trying to predict how the market will react to an election is like trying to predict the weather. It's nearly impossible. Just as weather forecasts can change rapidly, so too can market predictions. Many factors influence market movements, and elections are just one piece of the puzzle. Attempting to time the market based on election outcomes is a risky strategy that often leads to disappointment. Often, the market surprises us. Even seasoned investors can be caught off guard by unexpected market reactions. For example, a candidate who is perceived as unfavorable to the market might win, yet the market could still rally. Conversely, a market-friendly candidate might win, and the market could still experience a downturn. These surprises underscore the difficulty of making investment decisions based on election outcomes. We might see a dip after an election, followed by a quick rebound or vice versa. These fluctuations are part of the market's natural ebb and flow. It's important to keep a long-term perspective and not get too caught up in short-term movements. Reacting to every dip and rebound can lead to poor investment decisions and missed opportunities. The key takeaway is this: don't panic. Staying calm and composed during election years is crucial. Panicking and making impulsive decisions can be detrimental to your investment strategy. Instead, focus on your long-term goals and maintain a disciplined approach. Remember, successful investing requires patience and a steady hand. Knee-jerk reactions to election results can be detrimental to your long-term investment goals. Making decisions based on fear or excitement can lead to costly mistakes. It's important to avoid the temptation to make drastic changes to your portfolio in response to election news. Instead, take a step back, review your investment plan, and make adjustments only if they align with your long-term objectives. Instead of making emotional decisions, stick to your plan. A well-thought-out investment strategy takes into account various market conditions, including election years. By sticking to your plan, you can navigate the ups and downs of the market with confidence. Regularly reviewing and adjusting your plan as needed can help you stay on track and achieve your financial goals. Remember, the stock market is driven by more than just politics. While elections can have an impact, they are just one of many factors that influence market performance. Economic fundamentals, corporate earnings, and global events all play a significant role. Keeping this broader perspective can help you stay focused on your long-term investment strategy. Economic fundamentals, corporate earnings, and global events all play a part. These factors often have a more lasting impact on the market than election results. By paying attention to these broader indicators, you can make more informed investment decisions. Staying informed about the overall economic environment can help you better understand market movements and make strategic adjustments to your portfolio. Focus on the long game and resist the urge to make impulsive moves based on short-term political noise. Successful investing requires a long-term perspective and the ability to stay the course, even during turbulent times. By keeping your eye on your long-term goals and maintaining a disciplined approach, you can navigate the uncertainties of election years and continue to build wealth over time. Section 5. Industry Spotlight, Winners and Losers. Different industries can be affected differently by changes in the political landscape. Some sectors might benefit from a particular administration's policies, while others might face challenges. For example, the healthcare industry is often sensitive to changes in government regulations. A president who prioritizes healthcare reform could impact the profitability of healthcare companies. Similarly, the energy sector might see shifts depending on a president's stance on climate change and renewable energy. It's important to remember that these are just examples. The specific impact on each industry can vary depending on the specific policies implemented. As an investor, it's essential to stay informed about potential policy changes that could affect your investments. Diversifying your portfolio across different sectors can help mitigate risk. Section 6. Taxes. What could change? Taxes are a hot-button issue in any election. Changes in tax policy can have a significant impact on your investments. For example, a decrease in the capital gains tax rate could benefit investors, while an increase in income tax rates could affect your overall returns. During a presidential campaign, candidates often propose different tax plans. It's important to understand the potential implications of these proposals on your investments. Pay attention to details like changes to income tax brackets, deductions, and tax credits. Keep in mind that campaign promises don't always translate into actual policy. The president needs the support of Congress to enact tax changes. Working with a financial advisor can help you navigate the complexities of tax policy and make informed investment decisions based on your individual circumstances.